My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make some money. My job is not just to entertain, but to educate, to teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Say it ain't so, Salesforce. This longtime market darling, one of the great growth stocks of our era, finished the day down nearly 20% after missing its quarter, cutting its forecast, and just all around laying an egg. It's a breathtaking comeuppance for this cloud king, the first serious shortfall since the Great Recession. It laid the entire market to waste because Salesforce is a component of all three major averages. Hence why the Dow lost 330 points, S&P sank 0.60%, and the Nasdaq tumbled 1.08%.
The House of Pain.
Salesforce is a company that I've championed since it started, well, I guess really since it came public, to the single digits back in 2008. Yeah, I became a believer because I was still at TheStreet.com, which I founded in 1996, and when we used Salesforce, the product, I couldn't believe how much of a lift we got in selling subscriptions. You use Salesforce to get new clients and keep existing clients happy. They predict your clients' behavior, and in an artificially intelligent world that measures value by who has the most data, they are the data keeper. I have never heard of an unsatisfied customer of Salesforce, and I sure wasn't. Never. More important, Salesforce is a distinguished member of what has been the most esteemed cohort in the entire market for almost a generation, and that is enterprise software. This is the kind of software that automates business processes, manages data, manages your company's interactions with customers, handles your enterprise resource planning, and takes care of your business intelligence. In other words, enterprise software automates and digitizes every aspect of your output. It's vital if you run a business, which is why there are so many companies that provide enterprise software for many different areas. You want to sell product, you use Salesforce. You want to keep track of the numbers, there are half dozen companies that can do it for you. You want to help analyze personnel, handle human capital management, deal with supply chain, keep track of the finances. Well, there are another dozen of companies that can help you. You need to be protected from cyber bandits. There are myriad cybersecurity software businesses. You want to onboard people, design a website, keep track of receivables. There's 100 companies that make enterprise software for those spaces, not to mention the hundreds of private enterprise software companies that are just praying to come public. And that's the real issue. A material reason for Salesforce's shortfall. There are so many of these companies, so many publicly traded enterprise software names, we can barely keep track of them all, and they are all nipping at each other's heels, making it much harder to be in this sector than it used to be. Yet these firms keep being pumped out of the venture capital well because it has been the most lucrative part of the entire tech complex since the beginning of time, or at least since the beginning of Microsoft. Everyone in the industry knows that the easiest road to riches is to sell, not to the individual, but to the enterprise. And every young person coming out of any major school that does computer work, they know to go into enterprise software. As Mark Benioff, the CEO of Salesforce, could tell you, these companies cleaned up during COVID. Enterprise after enterprise signed up for the new software subscriptions. It was a heyday for the entire industry.
House of pleasure.
In part because many of these enterprise software tools can help remote workers collaborate. Maybe too much of a heyday. Companies just spent too much on their vendors, ordered too much, apparently much more than they can use or even open. Then something happened that nobody counted on. Generative artificial intelligence and the possibility that there are whole new sections of your company that can be automated. Stuff we couldn't imagine automated before. Are there superfluous people? And if so, how many? Where do we shift them to? Can machines do everything better than humans and for a cheaper price? What can they do better? Do we need to keep hiring if each person may not be as good as the AI co-pilot? Do we need anyone in our call centers? How about accounting? Contracts? Right now, big-time executives in every kind of business, from law firms, accounting firms, to retailers and bankers, they keep pondering, who do they really need? Do they need to hire? Well, who can they let go? With higher interest rates and an increasingly uncertain world, why bother bringing in more enterprise software at all? Remember, this is cloud software where you typically pay a subscription per user. Who the heck would pay more when they expect to have fewer people using stuff? How many fewer? We don't know. And that's where we find ourselves right now. You saw it with Salesforce. Then you saw it again tonight with MongoDB, the next-generation database management platform. Massively disappointed when reported after the close. Only see its stock annihilated after hours. So far this earnings, we've seen by the same thing, by the way, with Workday. Increasingly, there's concern about ServiceNow, Adobe, two tremendous competitors. I like Adobe's stock's been going down for a while. Meanwhile, many once lowly hardware companies, well, they're finally doing terrific. HP Inc. surging nearly 17% today. There are just too many enterprise software companies that are offering to analyze your data, interrogate your data, shift your data, spread your data, massage your data. And out of nowhere comes the greatest technology game changer in recent history, generative artificial intelligence. Thus, in the stock market, it's tremendous value creator, as you can see from just glancing at the chart of NVIDIA. But for those who are selling software that dealt with traditional mode and the traditional model, pre-artificial intelligence, AI kind of feels increasingly like a coin toss. Could be a bonanza if they get fit right into the new paradigm, but it could be the beginning of obsolescence if they can't. Do we need as many auditors if ChatGPT can audit? How about low-level accountants? What do we say to those who create documents, the same documents over and over again, ones in law firms and corporate finance? So suddenly we're in a frightening situation where companies need to say something very different to Salesforce than they've been saying. Certainly something they haven't said maybe in over a decade. They say, Mark, we have to wait and see. We're playing with co-pilots doing remarkable things. Or, Mark, we're thinking of putting our whole outfit in the hands of Dell, which is managing the transition for us, so we can't handle something new right now. Or maybe, perhaps worst of all, Mark, we have no idea how many people we really need, so we have to figure out first, and then meanwhile, business is slowing anyway, so we got to do measured thinking here. We got to take our time. We need many people in on the decision. I'm sorry. We'll have to see you soon. The enterprise software people have had the run of the joint for so long that their stocks have become richly valued, and for good reason. They've had consistently high growth, good profit margins for a long time. Now that growth is threatened like never before, and companies like Salesforce barely saw it coming, or even thought the AI boom would be, they thought it'd be great for them, everyone's frozen. It turns out maybe it wasn't so good. It might be in the future, but who knows? For now, these enterprise software companies feel like they're rudderless and their stocks are listless, not lifeless. And guess where they're going?
The house of pain.
But companies do engineering software, companies like Cadence that we had on last night, they are in ascendancy. Anything that can make or help make transistors or semiconductors is worth far more than it used to be. A personal computer can soon be an AI-powered personal computer. A robot armed by NVIDIA's Blackwell chips may render vast swaths of the workforce obsolete. No matter what, the halcyon days of enterprise software may have run their course, and unless interest rates come down, I don't see their stocks making a comeback anytime soon. Worse, the fact that these stocks are no longer immune from the business cycle is outright frightening to many people. They're filled with software for what might turn out to be superfluous people, whether in sales or marketing or coding, and you're supposed to pay by the person. Now, I'm not going to write off Salesforce. Too much cash flow, too good, too many smart people. When the smoke clears and the stock works its way down, perhaps under 200, call me a buyer, provided we have requisite number of downgrades that help shake out all the weak hands. Can't have them in there if we're going in. But the bottom line, we may be at the beginning of the great unwind of most enterprise software and the great ascendancy, not of the people picture with Jensen Huang, but of the ultimate clients who use his wares to figure out how best to put their employees to work in a world where AI is changing the entire business landscape. It's a changing the guard. And until some of these enterprise software companies drop to the point where they're more reasonably valued, just like the rest of the market, they are a very, very tough stocks to buy. Let's go to Natalie in Tennessee. Natalie.
Booyah, Jim.
Natalie.
My fiance Kyle and I watch every night and are members of the investing club, so thanks for all that you do.
Of course.
Question for you. I've got a small position in Estee Lauder. Is now the time to buy more or hold?
Well, I debated that today when we had our conference call. We had our club meeting at 12 o'clock. And what I said was, until I see something actually good out of the company, I can't keep buying it. It is a horrendous stock. It's the worst stock that we own now. And one of the reasons why it's the worst stock that we own is because that China was bad. But China's inventory has been cleaned out. So I'm not as negative as the street. But there's no doubt about it. EL, I need to see something, anything positive, any sign, even just like maybe like a bottle of Mac. All right, let's go to Daniel in New Jersey, please. Daniel.
Jim, thanks for taking my call.
You're quite welcome.
Jim, I was calling you about Snowflake, SNOW.
Sure.
I'm wondering if the company has been overly damaged from what's going on in the technology sector. Snowflake, as you know, is a very powerful company in the AI space. And just wondering, what do you think of it moving forward?
Well, I think that Snowflake's part of this vast cohort that I'm very worried about that really is. Now, look, they're not an enterprise software so much as a complete cloud system. But I would say that my fears are that that gets brought down like everything else, and the money's going to other sectors and staying away from that one. So it is a collateral damage situation because the quarter, you're absolutely right, was not that bad. But it doesn't really matter, does it? Look, I hate to say it, but we may be seeing the beginning of a larger unwind in the once most loved group of the entire market, enterprise software companies like Salesforce. And now we're seeing the ascendancy of companies using AI to optimize their businesses however they can, and maybe with less enterprise software. Maybe I'm sorry. Best Buy soared higher after earnings crossed this morning, and with the PC refresh cycle on the horizon, could this charitable trust name continue to be a winner? Don't miss my exclusive with the CEO. Then I first turned in my homework on electricity company Vistra last August, but it's nearly 250% run. Well, is it warranted? I'm breaking down the business again to see if we can keep powering it higher. And the maker of spam and planners reported before the bell today, so I'm checking in with Hormel's CEO after a slower quarter brought the stock down hard. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.